A peak and throw dilemma. Occasionally, peak and throw progression becomes more complicated than the examples shown in Figure 1.3 and 1.4. In Figure 1.5, example A, the market has been advancing in a series of rising peaks and troughs, but following the highest peak, the price declined at point X to a level that is below the previous low. At this juncture, the series of the rising troughs has been broken, but not the series of rising peaks. Figure 1.5, half signal reversals. In Figure 1.5, example A, the market has been advancing in a series of rising peaks and troughs, but following the highest peak, the price declines at point X to a level that is below the previous low. At this juncture of the series, the rising troughs has been broken, but not the series of rising peaks. In other words, at point X, only half a signal has been generated. The complete signal of reversal of both rising peaks and troughs arises at point Y, when the price slips below the level previously reached at point X. At point X, there is quite a dilemma because the trend should still be classified as positive, and yet the very fact that a series of rising troughs has been interrupted indicates underlying technical weakness. On the one hand, we are presented with half a bearish signal, while on the other hand, waiting for the point Y would mean giving up a substantial amount of the profits earned during the bull market. The dilemma is probably best dealt with by referring back to the second half of the definition of technical analysis given at the beginning of this chapter and riding that trend until the weight of evidence proves that it has been reversed. In this case, if the weight of evidence from other technical indicators such as moving averages, volume, momentum, and breadth overwhelmingly indicates a trend reversal, it is probably safe to anticipate a change in trend, even though peak and through progression has not completely confirmed the situation. It is still a wise policy, though, to view the signal with some degree of skepticism until the reversal is confirmed by the interruption in both series of rising peaks as well as troughs. Figure 1.5 example B shows the type of situation for a reversal from a bear to bull trend. The same principles of interpretation apply at point X as in figure 1.5. Example A. Occasionally, determining what constitutes a rally or reaction becomes a subjective process. One way around this problem is to choose an objective measure, such as categorizing rallies greater than, say, 5%. This can be a tedious process, but some software programs such as Metastroke with a zigzag tool enable the user to establish such benchmarks almost instantly in a graphic format. What constitutes a legitimate peak and trough? Most of the time, the various rallies and reactions are self-evident, so it is easy to determine that these turning points are legitimate peaks and troughs. Technical lore has it that a reaction to the prevailing trend should retrace between one-third and two-thirds of the previous move. Thus, in figure 1.6, the first rally from the trough low to the subsequent peak is 100%. The ensuing reaction appears to be just over half, or a 50% retracement of the previous move. Occasionally, the retracement can reach 100%. Technical analysis is far from precise. Reading again. Most of the time, the various rallies and reactions are self-evident, so it is easy to determine that these turning points are legitimate peaks and troughs. Technical lore has it that a reaction to the prevailing trend should retrace between one-third and two-thirds of the previous move. Thus, in figure 1.6, the first rally From the trough, low to the subsequent peak is 100%. The ensuing reaction appears to be just over half, or 50% retracement of the previous move. Occasionally, the retracement can reach 100%. Technical analysis is far from precise. Figure 1.6, identifying peaks in troughs magnitude. 100% of advance. Retracement should be about one-third to two-thirds of the previous move. Technical analysis is far from precise, but if a retracement move is a good deal less than the minimum one-third, then the peak or trough in question is held to be suspect. Sometimes, though, it takes the form of a line or a trading range. The depth of the trading range can fall short of the minimum approximate one-third retracement requirement, and in such instances, the correction qualifies more on the basis of time than on magnitude. A rule of thumb might be for the correction to last between one-third and two-thirds of the time taken to achieve the previous advance or decline. A rule of thumb, a rule of thumb A rule of thumb might be for the correction to last between one-third and two-thirds of the time taken to achieve the previous advance or decline. In figure 1.7, the time distance between the low and the high for the move represents 100%. The consolidation prior to the breakout should constitute roughly two-thirds. The consolidation prior to the breakout should constitute roughly two-thirds, or 66%, of the time taken to achieve the advance. Ample time to consolidate gains and move to a new high. These are only rough guidelines, and in the final analysis, it is a judgment call based on the experience, common sense, a bit of intuition, and perhaps most important of all, a review of other factors such as volume, support, and resistance principles, etc. The word common sense have been italicized because the chart should always be interpreted with a bit of poetic license. For example, the rule states that one-third retracement is required for a legitimate turning point, but it turns out to be 32%. If other factors suggest the move qualifies as a valid retracement, always take the common sense interpretation over the strict rule-based one. That is why we should regard technical analysis as both a science and an art. Figure 1.7, identifying peaks and troughs, time. Retracement is far less than one-third to the two-thirds of the previous rally. One-third or more of the time is taken to form the rally. We have mainly been studying these concepts in a rising trend. However, the principles work exactly the same in declining trend, in that rallies should retrace one-third to two-thirds of the previous decline. It is also important to categorize what kind of trend is being monitored. Obviously, a reversal derived from a series of rallies and reactions, each lasting, say, 2 to 3 weeks, would be an intermediate reversal. This is because the would be short-term in nature. On the other hand, peak and trough reversal that develop in an intraday chart are likely to have significance over a much shorter period. How short would depend on whether the swings were a reflection of hourly or say 5-minute bars. Summary: a number of different trends simultaneously influence the price level of any market. The three most important trends are primary, intermediate, and short-term. The principles of technical analysis apply to intraday trends, but since they are more random in nature, the analysis is generally less reliable than that for long-term trends. Very long-term or secular trends influence the magnitude of primary bull or bear markets. Peak and trough progression is the most basic trend identification technique and is basic building block of technical analysis. As a general rule, in order to qualify as a new legitimate peak or trough, the price should retrace between one-third and two-thirds of the previous move. Lines of consolidation also qualify as peaks and troughs when they form between one-third and two-thirds of the time taken to produce the previous advance or decline. Chapter 2: Financial Markets and the Business Cycle. Introduction. Our principal objective here is to explain the benefit of a technical approach, but it is also important to understand that primary trends in stocks, bonds, and commodities are determined by the attitude of investors towards unfolding events in the business cycle. Each market has a tendency to peak and trough at different points during the cycle in a consistent, chronological manner. An understanding of the interrelationship of credit, equity, and commodity markets provides a useful framework for identifying major reversals in each.